All right, everybody. Thank you for coming. I know it's hard to get away for 45 minutes out of your day, whether you're at work or you're retired. You've always got something going on. So we appreciate you guys coming. We will try to wrap this up by 11:45 so that you guys can all get back to everything that you've got going on today. My name is Jamin Garabedian. I'm with Post Oak Private Wealth Advisors. We are a fiduciary firm based out of Houston, Texas. We're holding this webinar today because I'm sure that you guys have all seen the roller coaster markets the last couple of weeks. With everything going on, we wanted to get this out there and get some information to you guys. I've got Robert Wyrick, who's our Chief Investment Officer, who's going to go over kind of our outlook on the market, how you can capture the most of the upside while still protecting your portfolio to drastic downside turns, which is what everybody's pretty worried about right now, and the effect that this type of strategy will have on your portfolio over the long run. For the sake of staying on time, we're not going to be taking any questions during the webinar, but you will get a pop-up when we are finished that will allow you to ask any questions or leave any comments. We highly encourage you to do this so that we will know where we can help you better and also how we can do these webinars a little bit better the next time we do one. So without further ado, I'm going to turn it over to Rob, who has been featured on a number of financial sites, including Yahoo Finance, Houston Business Journal, Time Magazine, and was even interviewed by Seeking Alpha for his insight into investment philosophy, somebody that I think we can all learn a little something from. So here is Rob Wyrick to present the rest of the webinar for
you. Thank you, Jamin, and hopefully my microphone, it looks like it's hopefully working. We've done this before where we had technical difficulties, so I'm always just a bit paranoid. So I think before we get started, it probably would make sense to just sort of talk for a couple of minutes about what's going on in the markets these days, at least in terms of what we understand and what's clear. So, so the economy has been chugging along at a slow growth rate, but the economy has been growing ever since we've sort of come out of this credit crisis in 2008. And it's been sluggish, and of course that was a lot of the talk throughout the election, is that we need to stimulate the economy, we need to make it grow faster. And what we've seen over the last few months, I mean, we certainly had a big rise in the market since the election because there was some optimism among a lot of investors about a stimulus package and a tax bill, et cetera. And the market is very fickle, and investors are very fickle. And sometimes what happens is sort of counterintuitive, but it makes sense when you kind of unravel it. And so the stimulus package, bear with me. And so the stimulus package has, the tax package rather, I'm sorry, has created a lot of optimism about the economy. Lower corporate tax rates means higher earnings, means more stimulus for the economy. And at the same time, the budget and the spending package has really created a kind of a budget deficit whereby the government's going to be spending a lot more money than we're taking in. And so the net result of that is now it looks like the economy has the potential to grow at a much higher rate, but now there are worries about inflation, right? Which stands to reason. Unemployment is at the lowest rate we've seen in years and years, and so there's a potential for wage inflation, right? I mean, if there's more need for employees and less available workers, then we're going to see wages increase. And that is ultimately what sort of triggered it. You know, we saw the employment numbers come out at record paces, and investors started saying, wait a minute, this stimulus package, this tax package, and the spending may be like throwing gasoline on a fire that's already burning pretty well. And so ultimately that's what took it down. I mean, there's fear that we'll see inflation, and inflation will lead to higher interest rates, which will be sort of kind of dampen down the economy, if you will. And I think that's it. And there are a lot of other technical reasons. I mean, that's why it started. Wall Street is notorious for creating products that sometimes serve as self-defeating, these leverage type products that kind of weigh on the market, and they cause more selling than what we would normally see in a regular market. And so that's it in a nutshell. I mean, we saw a rise in the market, kind of a crazy run up through a couple of weeks ago. Then the market kind of took a breath and said, wait a minute, this thing may be growing too fast. And so let's pause, let's pull it back. And it wasn't a bear market, certainly, but it was a correction. And now we're back to about where we were January 1st. And so that is just kind of an interesting time, and that's what's going on right now, and we'll see how this all plays out over the next few weeks. Okay, so with that said, I'm not going to spend a lot of time on a couple of these slides, especially because we took a couple of minutes in the beginning to kind of veer off. I'll only say, I guess, a couple of things about our firm. One is that we're a fiduciary. It's kind of a big thing. If you don't know what that means, it's probably worth Googling. But a fiduciary firm is obligated to act in our client's best interest, similar to an executor on an estate, or an attorney, or hopefully your physician. And so, and that differs quite a bit from brokerage firms, where they actually aren't held to that fiduciary standard. It's kind of an area that's been in the news a lot over the last couple of years, and so it's worth understanding. And the only other point is that we, our firm is very specialized in that we have a lot of expertise just because of our background in terms of managing risk. And that is the crux of why most people sort of listen to us and talk to us and work with our firm. And we're going to talk a little bit about that today. And the same thing here. I mean, we get asked to comment with the various media sources, not because we're special, but it's because we do have a kind of a unique area of specialization. So today we're going to talk a little bit about mathematics, but hopefully in a fun and exciting way. We're going to talk about why math matters in investment returns, a couple of important concepts with regard to investing. We're going to talk about understanding the importance of limiting a downside capture. This is a big deal. And so we're going to spend a couple of minutes on that. And because there are a lot of misconceptions, I believe, among investors and even professional investors. We're going to talk about what I call the balanced portfolio conundrum and attack of the clones. Without giving too much away, I mean, I was talking to a client recently that left one of the big energy companies, and when he got his package, a lot of clients went to work with a particular firm here in town, and the whole conversation was about 60-40. Are you in a 60-40 fund, meaning 60% stocks, 40% bonds? Are you 60-40? Are you 65-35? Are you 50-50? And so this way of investing among all these various firms, from the big custodians to these robo-advisors, we have a situation where the whole world is largely investing the same way, and that creates some unique situations. And in fact, we saw some of that playing out when the market corrected. But we're going to talk a little bit about that and how maybe this attack of the clones may or may not be the best thing for you individually. We'll talk about managing distribution risk, and we'll touch upon how we actually manage risk. So even with this pullback we had over the last couple of weeks, the stock market is still near all-time highs. Bond yields are still near historic lows, but they're rising. This is a huge deal that we're going to talk about here in just a minute. Sequence risk, that's the risk of the market not moving in your favor as you near or enter retirement. And an example of that would be 2008. So for example, you have, for round numbers, you have $1 million of retirement money, and you need to generate $40,000 or $50,000 a year in income. That's a very doable, that's a very realistic expectation. Well, let's say we have a 2008, 2009, and again, for really easy math, pardon me, the market takes away half of that, and so now you have $500,000. Well, your need hasn't changed, your income need hasn't changed. You still need 40 or 50 grand a year to live on. That's a constant, but now that represents a 10% withdrawal from your savings. And there are very few scenarios whereby that money is going to last. It's a virtual impossibility. And so making sure that you are not putting yourself in a position to have a bad sequence, if you will, because the markets are going to do what they're going to do. But you have to protect yourself from that sort of a downturn, in our opinion. It's a big deal. Again, protecting wealth and irreplaceable capital and longevity risk. People are retiring younger, living longer. So this idea of funding 25, 30 years of retirement is, at the end of the day, it's still a fairly new concept. Pardon me. So, so there have been 25 bull markets in the U.S. since 1929. And the current bull market is still the second longest in U.S. history, and it is still a bull market. I mean, we haven't entered into any bear market territory. What we had over the last couple of weeks would be considered sort of a classic correction, if you will. So this current bull market is about 106 months in duration with about 248% gains versus the average. It's about 3.5 years with about half the gains of about 103%. Now, I always caution because those are just numbers. Those are just statistics. I don't necessarily believe that means that we're on the verge of a bear market. I mean, it could end up being the longest positive bull market in U.S. history by a wide margin. Nobody knows. And so we like equities for the long run. I think a person has to have some element of equity in their portfolio, whether it's in real estate or whether it's in the stock markets, because prices go up, inflation is ever present, and inflation may become more ever present. So you have to have a mechanism for keeping up with inflation. However, there is risk in the markets. And since 1929, there have been 25 bear markets, which is defined as a 20% or more loss, or again, about every 3.5 years. Average bear market took the market down about 35%, et cetera. And so, like the markets, we think people have to generally participate in order, again, to keep pace with inflation, but there is risk. And the thing that I've learned over the years is that we don't ever know what the reason is. And so even though there's some fear about inflation right now, when you look at the fundamentals of the market, when you look at corporate earnings, they're really good right now. I mean, corporate earnings are increasing, especially since the tax legislation has been passed. Companies are growing, consumers are optimistic, consumers are spending money, et cetera. And so if you look at the fundamentals, they're generally great. But what will take the market down one day will be something completely out of the blue. It'll be something that's not on our radar. It could be some sort of a major internet outage that spooks investors because Wall Street goes down. It could be, something going on in North Korea. We don't know what it'll be, but it's normally not the thing that's on our radar. And so you got to love the market, but you also have to respect the level of risk that it involves. And so the next couple of charts are kind of interesting, and we've talked about a couple of math concepts that are important, and this one we call the power of compounding. And so the ability to compound returns over time is the key to asset growth and wealth accumulation. But of course, it works best when returns are more consistent and more positive. So large investment losses are certainly painful in the short run, but in the long run, they can be devastating. So as an example, a loss of 50% over 1 year can wipe out 9 years of steady returns. In other words, one bad year in a decade of consistent positive returns can put an investor right back to where they started 10 years earlier. And a lot of us have seen that. We saw that in 2000, we saw it in 2008, and people are constantly sort of climbing back from the abyss after the market does what it inevitably does, which is correct. It's what markets do. But the markets do recover. I mean, they recover over time, but those who are near retirement don't have the luxury of unlimited time. And so compounding and having a steady rate of return is an important concept in investing. I think that we have to pay attention to. This one, a lot of people have seen variations of this slide, but the point is that to recover from a drop in investment value requires a gain in excess of the loss. And so, for example, when the market was down 10% over the last week and a half or so, it didn't require a 10% gain to get back to where a person started. It required 11%, which is notable. But if the market goes down 40%, it doesn't take a 40% return to get back to where a person was. It takes a 67% return. And so, we talk a lot about participation in the market, but it certainly requires a higher participation on the upside. But if I had to point to a single slide that we cover today that I think has the most significance and is the most important, it would be this slide. And it looks a little bit confusing on the surface, but let me explain. Oops. So if a person participates, an investor, in 100% of the downside of the market, then they have to obviously participate in 100% of the upside in order to achieve market returns. And so a lot of what we hear about these days are index funds, which are fantastic, and you can buy an S&P 500 fund and you can participate, very economically in 100% of the upside of the S&P 500. That's fantastic. I do like that. It also means that you're going to participate in 100% of the downside. But the biggest misunderstanding, the biggest misnomer among, again, even professional investors and managers, is that if you are only participating in a fraction of the downside, then you don't need as much upside to actually outperform the market. And so what I mean by that is, if, for example, you're only participating in 40% of the downside of the market, then you only need 55% of the upside to outperform the market over a full cycle. And as you slide on down the graph, so if you're participating in 60% of the downside, then you need roughly 70% of the upside to outperform the market over time. And so there's a lot of ways to achieve market returns. The most risky certainly is to try to participate in 100% of the upside, because that means you're participating in all of the downside. And so the sort of the quote is, avoiding a loss is equal to achieving a gain of a greater magnitude. And I'll say that again, but avoiding losses is equal to a gain of a higher magnitude. So you can outperform the market over time by participating somewhere in here if you're not participating fully in the downside of the market. So I don't want to get too caught up on that, but it's an important concept to understand, perhaps the most important. So when we talk about the balanced portfolio conundrum, was what I call it, and attack of the clones, this is a really interesting time that we live in. And so if you look at, and I get a report I think it's every quarter, called the Robo Report, and it compares the portfolios of the major custodians, Schwab, TD Ameritrade, who's our custodian, Vanguard, then some of the new robo advisors like Wealthfront and Betterment, and you kind of go down the line, and it compares the portfolios and the returns of all these firms. And what's fascinating is that they are all largely the same, with some slight variations. The performance is the same, the allocations are the same. We talked again about kind of I think I can go to the next slide, but kind of a 60-40 type portfolio. And so even though the makeup may be slightly different with the various firms, I'm so sorry, they're all generally the same. And so, and the concept is this. And some of you, I see some familiar faces and names on here. And so some of you have heard me speak about this, and I'll climb on my soapbox for just a minute, if you'll bear with me. But it works like this. The concept is this, that if you piece together a portfolio that's made up of various asset classes, and an asset class would be large company stocks and small company and value and growth and European, et cetera, international real estate, that if you piece together a portfolio of all these components, this is called modern portfolio theory, by the way, then when the market corrects, then you're going to have a much smoother ride, because they're not all going to correct at the same time. They're all going to go down at the same time. But the reality is that every time the market corrects, and this was true 2 weeks ago, this was true in 2008 and 2000, and every market that's ever been corrected, all these asset classes tend to behave largely the same when the market goes down. They just do, and especially in the globally connected economy that we live in now. And so if I want to know what the US is going to do, it probably makes sense to see what Europe did or what Asia did overnight, because as goes one of these markets, as goes all the others. And so maybe they don't move down in lockstep, but they just generally go down at the same pace. And so what Wall Street seems to do is to use hindsight and say, okay, listen, so in the last correction, for example, in 2008, there were a couple of asset classes that maybe didn't do quite as poorly. And so let's include more of those. Let's put in some managed futures, and let's put in some international bonds, or maybe let's put in more commodities, because those didn't do quite as badly. They had a lower correlation. But the reality is it's all investing in the rearview mirror, because nobody knows how these asset classes will correlate during the next correction. Although we kind of do. They kind of all correlate the same. Again, maybe not exactly the same, but they tend to all go down. And so to me, that is investing sort of based on hope, just sort of hoping that these asset classes will, first of all, hoping the market will continue to go up, but also hoping that they don't have a high correlation, and that somehow by having all these different asset classes that they serve to shield some of the risk. Now pardon me, I will call your attention to the red line, because this is kind of the next phase of what we want to talk about, and this is the bond portion of the portfolio. So if you can picture again a 60-40 portfolio or 50-50, and this represents your equities, and this represents bonds, which are meant to kind of shield and dampen portfolios against market risk. And it's a legitimate strategy, by the way. It makes sense. And so in 2008, when the market was down roughly 39%, a portfolio that was blended, 60-40 would have been down just under 24%. That's still a big drop, by the way. I mean, 24% is a big drop. But the bonds did what they were meant to do, which was to sort of hold steady and shield a big portion of the portfolio from risk. But there's a couple of points here. One is that not only have we been in the midst of one of the biggest bull markets in U.S. history in equities, it's been the same for bonds. And so there are only a few absolutes in finance. And one of them is that when interest rates go down, then bond values go up. And look, to understand it is really simple. So if you have a bond that you paid $1,000 for, and it has a 2% coupon, 2% interest rate, if you will, and interest rates go down to 1%, all of a sudden your bond is worth more money, because it would take someone, they would have to pay you additional dollars to buy that bond, and vice versa. And so it's an absolute. Interest rates go down, bond prices go up. And so during the midst of, and this has gone on for 20 plus years, and so during the midst of the 2008 correction, bonds held up quite nicely. But this inverse relationship exists. And so when interest rates go up, bond values go down, and vice versa. And so what has been going on over the last, really since the latter part of last year, is that interest rates are going up. And so this is a year-to-date measure of the 10-year Treasury. So it's gone from about a 2.45 or so interest rate, 2.45, to about a 2.92. This was, I think, as of this morning, maybe yesterday. And so interest rates are going up. And so what does that mean? I mean, interest rates are going up. That means bond values are going down. And I don't know. And so this measures, for example, I grabbed this morning just the 1 month return on the Vanguard total bond market. Again, great fund. I mean, it's a great fund, great low cost way to get bond participation. But as interest rates go up, bond values will go down. And so what I fear is that especially for people who are in retirement, like this whole group from ConocoPhillips, that they're all in these 60-40 funds, it makes academic sense to a large degree, but to a large degree it doesn't, because if we get a market that is going down because there's a lot of fear of inflation, then that also means that bonds are going down because interest rates are going up. And so you kind of get this 1-2 punch that ends up being very devastating. So you get a 25% decline in stock prices, and then interest rates go up even 1%. That represents about 10% decline in bond values. And so all of a sudden, the portion of the portfolio that is supposed to be protecting investors is no longer protecting them. And there's a lot of risk. And I think that, and it's not fully understood. And as people sort of plug into these various platforms with all these various firms, these autopilot type allocations. Again, there's worse ways to invest. I mean, for certain, but there are inherent risks that maybe not be recognized right away. And so we'll see. I mean, interest rates seem to be heading north, and we'll just see what that means for inflation and for the markets. So if asset allocation and market timing don't solve the risk problem, what does? And as an aside, we didn't really talk about market timing. That market timing is something that we all would love to be able to do, but nobody has ever really done, that I know, has ever really done it successfully over time. And that means, trying to time when it makes sense to be in stocks or cash or bonds. I've seen people do it successfully for a time or two, but it's impossible to do over the long term. And that's my opinion, but I've never seen anybody, sort of prove me wrong on that one. It's just very difficult to do. So asset allocation, market timing don't solve the risk problem. Traditional asset allocation hasn't been enough and isn't in the past and isn't the answer, and hope is not a strategy. And I say that sort of tongue in cheek, but when you really think about the strategy behind a lot of portfolios. I mean, they're certainly well thought out in a lot of cases, but at the end of the day, it's ultimately hope that everything works out in the way that it's been planned. And so I'm going to talk for a couple of minutes, and this isn't necessarily, I mean, the idea isn't to pitch our portfolio, but to talk about the concept behind it that actually is the takeaway for today, if you will. And so just in terms of the mechanics, so we assemble a portfolio of blue chip stocks and index funds. Do I think that managers can outperform the stock market by choosing a basket of stocks? Probably not. Sometimes yes, sometimes no, but generally no. What you can do is you can assemble a portfolio that has much lower risk than the overall market, which is the goal. And so here's the takeaway, if you will. So you have an underlying portfolio, and whether it be blue chip stocks, whether it be index funds or whatever, it's not as important. And then you allocate about 2%, which is what we do, to a protective hedge. And I'll talk more about what that means. But a protective hedge is meant to mathematically, this is an important point, limit downside risk, protects against significant losses, and provides liquidity when it's needed the most. And then I'm going to come back to the hedge in just a minute. And so this is just a slide that talks about how we choose the equities that go in our portfolio. And again, it's not as important. I mean, a person can make an argument for high dividend paying, low volatility stocks or index funds. It almost doesn't matter. We use both, and it almost doesn't matter how the equities are chosen in the portfolio. The lower risk, the better, obviously. And so a protective hedge is literally an instrument that is sometimes referred to as portfolio insurance, but it is an instrument that goes up significantly when the market goes down, and it goes down when the market goes up. And so what we've done for years and years and years is we allocate about 2% of our client's portfolio to a protective hedge that limits their downside risk to 7 to 8%, and adjust those hedges every 6 months or so. But the way it works is this. And so if you have 2% of a portfolio that's allocated to the protective hedge, and the market goes down, for example, like it did last week, the value of the hedge goes up astronomically. And so at the end of the second or third day of the correction, the hedge was up, had doubled in value. And you reach a point after the market goes down 5 or 6 or 7 points where the hedge is fully protecting the portfolio from further corrections. And at that point, you have the opportunity to sell this hedge that's worth so much money. Look, for lack of a better description, if you can kind of liken it to homeowners insurance. You have a fire, your house catches on fire, and you get the check from the insurance company that allows you to rebuild. And so this is what goes on in your portfolio. And so you have an opportunity to sell that hedge for many times what you paid for it, buy a new one, extend your insurance, if you will, out for another year. And then it gives you money to invest when everybody else is selling. And so when the whole world is selling and you have these major corrections and people say, man, it'd probably be a great time to invest if we had some money to invest, because we're certainly not going to sell. Well, that hedge provides that opportunity. Not only does it protect your portfolio from further downside, but it gives you money to invest in the market when everybody else is selling. And what I find so fascinating is that in virtually every industry, and the industries that a lot of us work in, whether it be oil and gas or airlines or farming, et cetera, there are almost always hedges in place to manage the big risks that lie outside of our control. And again, as an example, a farmer may hedge his bet by locking in crop prices. Airlines hedge their bets by locking in fuel prices. Oil companies hedge their bet by locking in the price of oil. And the goal with all of these is to manage the big external risks that could ruin any of these companies. And again, the fascinating part to me, having done this for so long, is that yet in most cases, most investors fail to protect their largest asset, which is their retirement savings. And there are a lot of products out there. I see some of the annuities that are just super, super expensive. And there are products out there that are designed to sort of do this, but they're very expensive and they don't allow clients to fully participate in the market. And so this slide could, I think, probably be better. But the point is that normally we would set the protection at about 7%. That seems to be the optimal point. Some clients are willing to accept more risk, and they'll set the protection at 10% or 12%, or in some cases higher. They don't want to take any risk. Now, if you the less risk you are willing to take, the more it detracts from returns. And so if you have a hedge, protective hedge that's set at about 7%, of course, it detracts from returns on the upside. And so you're going to participate in probably 70 to 80% of the return of the S&P 500. That's been our track record going back since the beginning of time. But remember the slide that shows that if you're able to participate in, if you're only participating in a fraction of the downside of the market, then you don't have to fully participate in all of the upside of the market to outperform. And so if you look at a 60-40 portfolio, for example, that was down in 2008, a typical asset allocation portfolio is down 24% in 2008. If you were only down 4% in a protected portfolio, you will outperform the market for the next 10 to 15 years because you're not having to climb back from the abyss like you would. And so in the imperfect world of investing, it's a very, very elegant and it's a very predictable solution because it doesn't rely on bond prices. It doesn't rely on inflation. We know mathematically that this hedge is going to protect. Now, I tried to get all of these on, pardon me, on one page, and so it's a little bit difficult to see. But this is a stress test, and this is probably the most accurate stress test that a person could run on investment portfolios. And in the middle, we have the S&P 500, and so. And what this does is it stresses a portfolio in various negative situations, like a credit collapse like 2008, or a Fed hikes rates and they keep hiking rates, or negative rates, et cetera. And it shows how it's likely to participate on the upside. And so it may be a little difficult to read, but the graph hopefully is fairly descriptive. So long-term anticipated return on the S&P is about 8% with a 2% dividend. And if you look over here, this is a traditional, with a crash rating of 71. And we could go into detail about how this is measured, but the higher the number, the worse. And if we look at a 60-40 portfolio, again, a traditional portfolio, you can see that the estimated long-term return is just right under 5%, 1.2% yield, dividend yield. And the downside is more managed. I mean, it's better than being fully exposed to equities. I think that the starting point we have to realize is that if you are approaching retirement or in retirement, you certainly can't be fully invested in equities. That to me is not an option. So it's better. So the return is way down. Participation is moderate. And if we come over here with a crash rating of 52, and if we come over here and look at a portfolio that has just 2% allocated to the protective hedge, what it does to the returns. And so here you are seeing a long-term anticipated return of 7.4, again, versus 8 for the S&P. So you're not fully participating, you're participating some. Dividends in this case are about 3%, which is higher. But you can see the predictability on the downside. And so what I did is just took a portfolio that is as it stands right now. And so it looks like the worst case is an 11%. If we see negative rates, which I can't imagine that being the case, and in a 2008 type correction, I'm not sure if that one is actually on here. So the S&P drops, the energy drops 40%, we're down 10%. Okay, a 2008 type collapse would be down about 6%. And so it brings predictability. And again, in an imperfect world, it would be great to be able to, I guess in a perfect world, it would be great to be able to hedge a portfolio and still have 100% of the upside. But here we're getting most of it, but you're not going to capture 100% because there's a cost to the insurance. Now a critic of this type of a strategy would say, well, listen, why, if the market goes up, 80% of the time or more, why would you always have a hedge in place 100% of the time? Because we know that it's a drag on performance. And the reason is the same reason that you can't buy homeowners insurance when your house is already on fire. Even if somebody would give it to you, it would be unaffordable because the risk has already been established. And it's the same way with market protection. When the market starts correcting, the value of this protection goes up so astronomically that it becomes unaffordable. And so you just own it and you sort of hate it. You know, you kind of hope that you have this one line item in your portfolio that's a terrible investment and that's your protective hedge, because that means that everything else is going up. And this will be something that we just hate and you hate and you hate. And then one day it becomes the best investment that you ever make. And so that's the reason you can't buy it. You can't time it. In essence, you can't buy it once the market starts going down. And just a couple more slides here, but this is a, you know, we talked a little bit about sequence risk. And so these are the three portfolios on the previous page. And what we did is we simulate a crash in year 1 and a crash in year 10. And these could be placed anywhere on the graph here. But if you look at the hedged portfolio, if you get a crash in year 1 and a crash in year 10, you still have more than you started with. I guess this one would be a 60-40, you know, well, let's look at this one. So this is the S&P 500. Look, if you get a couple of corrections along the way in the first 10 years, your portfolio is in trouble, because what we haven't even overlaid here are withdrawals, right? And so what if you're withdrawing 4 or 5% per year, and then you get these corrections, you're already at 50% of the value. This is not a situation a person wants to be in. And even with the blended portfolio, sort of this traditional thinking, if you will, a person still is in trouble. And again, these are two corrections spaced 10 years apart. On average, the markets correct every 3 or 4 years. And so whether you placed one here or one here and only had one, I mean, those are scenarios that are easy to run, but the outcome is generally the same. You protect and you are able to sustain your funds throughout retirement. And this is, I found this recently, but I just found it interesting. I mean, the chance of a market loss in any given year is about 22% versus the chance of all these other incidents happening, a house fire or a car accident, et cetera. And again, it's the one large asset that most people fail to protect. And so I will say, sort of in closing, just with regard to our portfolios, simple, transparent, cost-effective. Our fees at the top end of the range are below 1% and go down to 0.5%, which is lower than most money management firms that I've seen, and in line with some of the robo advisors. A distinct, proven approach to managing risk, fully invested, always protected, all the time, mathematically calculated downside protection, liquid portfolio, no surrender period, no lockup period. We aren't fans of annuities and things where you're paying these astronomical fees and they lock your money up forever and you barely participate in the market. Doesn't fall within our belief, core beliefs, if you will. And it's customized for every client. And what that means is, quite often clients will come to us with existing holdings. Maybe a person has left the company and they have a lot of company stock. And so we incorporate that. And so while in a perfect world, we would design a portfolio from scratch, at least half the time, we end up taking existing holdings and building our portfolio around those and then hedging those existing holdings. For sometimes there are tax reasons a person doesn't want to sell a holding. Sometimes there's emotional reasons or just a belief that this is going to be something that goes up over time. And a person doesn't want to sell those. And so we incorporate those holdings, and whether it be mutual funds or whether they be individual stocks or whatever. So it is customized for every client. With that said, I will turn it over to Jamin, I think, for some closing comments. I will just say that I appreciate your time. I hope that you have found this beneficial. And with that, Jamin, would you like to say anything as we close out?
Yeah, sure. Thank you, Rob. Thank you for holding this webinar and giving us some insightful information. And thank you for everybody for attending. I hope you enjoyed it and hope you're walking away with some useful knowledge. I also hope this kind of sparks some thought in your mind about your current portfolios and how you're currently positioned and if it's as well as you think it is. I'll be sending out a follow-up email to everybody that attended with a white paper that describes a lot about what Rob went over today. And if anyone's interested in discussing this in more detail, or if you have any specific questions about anything you heard today, or if you just like us to run a stress test like you saw Rob put up on one of the slides on your current portfolio, feel free to reach out to me at any time, respond to the email, or leave comments on the pop-up that you'll get as soon as this is over. That concludes the webinar for today. Again, I appreciate all of you for coming and joining us today, and I hope you have a wonderful rest of your day. Thank you.